What if I told you that two people could start with the exact same bank balance, make two completely different decisions, and 20 years later end up almost dead even? Except one of them spent 2 decades doing unpaid labor to get there, and the other one did nothing but sit still. That's not a hypothetical. That's math. And by the time we're done walking through it, you're going to look at every "buy real estate, it's a no-brainer" video completely differently. Picture two guys. Same age, same mid-sized city, same job title, same paycheck. Call them Derek and Elliot. Both of them have $48,000 sitting in a savings account, and both of them make $58,000 a year. That's it. That's the entire starting point. No trust fund, no inheritance, no secret advantage. Just two ordinary guys about to make two very different choices with the exact same pile of cash. Derek takes his $48,000 and puts it down as a 20% payment on a $240,000 rental house, a plain 3-bedroom in a neighborhood that's fine, not fancy. He signs a 30-year mortgage at 6.75%, which locks him into a monthly payment of about $1,246. Within 3 weeks, he's got a tenant paying $1,700 a month. Do the subtraction, and that's $454 of profit landing in his account every single month, before he spent a dime on anything else. Derek is walking around feeling like he just solved money. Elliot takes his $48,000 and does something almost embarrassingly boring. He drops the whole thing into a total market index fund, sets up an automatic transfer of $280 a month, and closes the laptop. No tenants, no keys, no Saturday showings. When people ask him what he's investing in, he says, "index funds," and watches their eyes glaze over immediately, because nothing about that sentence makes a good story at a dinner party. Here's the thing about day one. It isn't close. Derek's got a house, a tenant, a set of keys, and something he can drive past and point at. Elliot's got a confirmation email. Emotionally, there's no contest. But emotion and arithmetic are not the same language, and one of them is about to get a very expensive lesson in the difference. For the first stretch, Derek is living the landlord fantasy exactly the way it's sold to him. Rent lands on the first of the month like clockwork. He drives past the property thinking about equity. Come tax season, he writes off mortgage interest and depreciation and shaves a couple $1,000s off his bill. Meanwhile, home values in that neighborhood are creeping upward, and every uptick feels like a personal win. Elliot, on the other hand, checks his account once every few months, sees a number that wobbled up a little, down a little, then up a little more, and feels basically nothing. There's no key in his pocket. Nobody's calling him about a leaky faucet. It just looks like a static number that occasionally changes. Derek's friends ask him about the property constantly. Nobody asks Elliot about anything. If you measured success by how impressed your friend group is, Derek would be winning by a landslide. But real life doesn't settle its accounts based on how good the story sounds. So let's actually open the books at the 3-year mark, because this is where the fantasy starts meeting the invoice. Have you ever noticed how a rent check looks enormous right up until you start subtracting things from it? Over 3 years, Derek has pulled in roughly $61,200 in rent. His mortgage payments over that same stretch add up to about $44,850, which on paper leaves him with $16,350 in gross cash flow. Sounds fantastic until the real world shows up with its hand out. Property taxes run $2,880 a year. Insurance adds another $1,400. Then the surprises start landing. The water heater dies and costs $1,100 to replace. A slow roof leak costs another $2,600 to patch. And there's 1 full month of vacancy between tenants, which costs him $1,700 in lost rent, plus $550 to clean and relist the place. Derek's been managing all of it himself to save money on a property manager, which sounds smart until you realize what that actually means. 10 p.m. phone calls about a clogged drain, weekend afternoons showing the unit to strangers, coordinating contractors on his lunch break. When you add up everything real, Derek's actual net profit after 3 years lands somewhere between $1,800 and $3,800. Not the 16,000 that looked so clean on the napkin math. And that number doesn't include a single hour of his own time, which, if you paid yourself even a modest hourly rate for all that landlord labor, would erase the profit completely. Elliot, over the same 3 years, has put in his original $48,000 plus about $10,080 in steady monthly contributions. Averaging a 10% annual return, his account is sitting around $73,000. He spent 0 hours on it, 0 emergency phone calls, 0 contractors. But it's not all one-sided. Derek still has one card Elliot doesn't have, and that's leverage. His property has appreciated to roughly $266,000, and between that appreciation and 3 years of mortgage payments chipping away at the principal, his equity has climbed to about $80,000. That's real wealth, built partly with the bank's money instead of his own, and that's the one lever a stock portfolio simply can't pull. Everybody wants to talk about the rent check at the barbecue. Nobody wants to talk about what's quietly eating it alive. Think about vacancy first. The average rental sits empty about 1 month out of every year, and during that month, you're still covering the full mortgage out of your own pocket, while also paying to turn the unit over. Then there's maintenance and the big-ticket items, usually budgeted around 1 to 2% of the property's value every year. Some years, that's a $40 washer for a dripping tap. Other years, it's a $6,000 air conditioning replacement in the middle of a heat wave. And there's no negotiating with a broken HVAC system in August. Hire a property manager, and roughly 10% of your monthly rent disappears before it even reaches your account. Skip the manager, and you've essentially created yourself a second unpaid job. And then there's the nightmare scenario nobody likes to mention out loud: a tenant who stops paying and drags you through a months-long eviction process that can erase an entire year of profit in one swing. By year 5, Derek is fully living inside the reality of what being a landlord actually costs. He's on his 3rd tenant. He just paid $8,200 to replace the roof entirely. A plumbing emergency cost him another $1,300. Property taxes have crept upward again. His real cash-on-cash return is hovering somewhere between 3 and 5%. Respectable, but nowhere near the number he imagined on day 1. Elliot, meanwhile, is still doing exactly nothing. By year 7, his account has grown to roughly $136,000. He never tried to time the market. He just kept showing up, month after month, and let compounding do what compounding does. By this point, the growth generated by the money already in the account is outpacing the growth from his new contributions. That's the moment compounding stops being theoretical and starts becoming the whole engine. Now here's the part I want you to actually sit with for a second, because it's the point where most people's assumptions get flipped upside down. By year 10, Derek's property has climbed to roughly $325,000, leaving him with somewhere around $175,000 in equity. Meanwhile, his out-of-pocket costs for repairs, vacancies, and turnovers across that decade have added up to a real, uncomfortable sum. Elliot's portfolio, over that exact same 10 years, has grown to approximately $162,000. Look at those two numbers again. They're almost identical. One guy spent a decade fixing water heaters and dodging late-night phone calls. The other guy did nothing but let an automatic transfer run in the background. And they ended up in roughly the same place. By year 20, the paths finally split apart for good. Derek's property is worth close to $475,000, and after 2 decades of payments chipping away at the loan, his equity has grown to roughly $370,000, a real number, even though there's still a meaningful chunk of mortgage left on the books. But strip out the appreciation and just look at the actual cash he pocketed over 20 years of maintenance, tenant turnover, and at least 1 major renovation, and his real profit from cash flow alone might only be somewhere between $35,000 and $70,000. Elliot's account, compounding quietly at 10% with steady monthly contributions the entire time, has grown to roughly $420,000. More than $300,000 of that came purely from compounding. No debt, no tenants, No 3 a.m. phone calls about a burst pipe. Their final net worth numbers land in a similar neighborhood, but the 2 decades that got them there were nothing alike. Derek worked for every dollar of his wealth. Elliot simply waited for his. And here's a detail that should make your jaw drop a little. If Elliot had just bumped his monthly contribution up by $200 from the very beginning, his final number would jump to somewhere around $520,000. Stock contributions scale like that because every extra dollar compounds right alongside the rest. Try scaling up a rental strategy the same way, and what you're actually signing up for is a second mortgage, a second tenant, and a second set of 2 a.m. phone calls. Here's a question worth sitting with before we go any further. If both of these paths can lead to a similar number, what's actually separating the people who feel financially free at the end of it from the people who feel financially exhausted? That's not a rhetorical throwaway. That's the entire point of this video, so hold on to it. Now, to be completely fair, the stock market side of this story has real teeth too, and it would be dishonest to pretend otherwise. Volatility is brutal, and it does not care about your feelings. During a serious downturn, a portfolio can lose 35% of its value in a matter of weeks, and that kind of drop is genuinely gut-wrenching to watch happen to money you worked years to build. History is not kind here either. Most everyday investors panic during exactly those moments and sell at the worst possible time, locking in losses that a little patience would have erased. Index investing also doesn't hand you meaningful monthly cash flow. There's no built-in leverage multiplying your returns, and you miss out on the kind of tax advantages a rental property offers, like depreciation. Real estate genuinely does win in specific situations. When you treat it like an actual business, when you target a market where the rent-to-price ratio is strong from day one, when you house hack to cancel out your own living expenses, or when you use tax-deferred exchanges to keep growing your holdings without a tax hit along the way. Real estate isn't a bad investment. It's just wildly misunderstood by people who only ever look at the rent check and never look at the invoice. Before we wrap this up, here's the real trap hiding underneath this entire comparison. It's not real estate versus stocks, and it never was. The actual trap is picking either one off a headline, a confident friend, or a single viral video without ever mapping out the true cost in dollars, hours, stress, and risk. Anyone who tells you one asset always wins, every time, no exceptions, ask them if they counted every hour and every dollar, or just the ones that made for a good story. So here's the real question, and I actually want you to answer it in the comments before you go. If you had $48,000 sitting in your account right now, would you rather have Derek's keys or Elliot's quiet little account balance? There's no wrong answer, but I genuinely like to know which kind of wealth you'd rather build, the kind you actively manage or the kind that manages itself. If this changed the way you think about building wealth, hit subscribe, drop a like, and share it with the one friend who keeps saying real estate is the only real investment, because they need to see these numbers too.